Good day, fellow investors. Let's discuss the stocks you want to see analyzed. But before we do that, let me just discuss how deep one should research a stock, an investment opportunity, from a value investing perspective. On this Nike and Lululemon stock video, whenever someone disagrees with me on something, they always say I should dig deeper. Is this in your circle of competence? Should you know on why they bought it, this or that? That is a great point, and I want to explain what is value investing, how I have been doing it for the last 20-something years, and why it did really well for me. When it comes to value investing, I've been investing since 2002. I have been a professional analyst since 2015. If you just look at my Seeking Alpha article from 2016, buy Apple for the next 40 years, well, Buffett listened, he has done well. Now it's time to sell Apple. But I have been a professor of finance and accounting, I have a Ph.D. in stock risk analysis, and I have also been running my research platform with portfolios for now 7 years. And when it comes to investing, when it comes to analyzing businesses, I go on a need-to-know basis to say yes or not. Usually 99% of the investments I go so far as needed to say no. The ones that I say yes, that's a completely different story. Because value investing is about low risk equaling high reward. For example, Amazon was $80–90 a few years ago. I've made a video, it was $93, and I told you the risk is minus 30% and the reward is 2x. The reward materialized. Meta Platforms was also at 90, now is a little bit higher. I made a video, too cheap at 90 or 100 to overlook, even if it was 70% down. That is when you know enough, because it is all about risk and reward. Here, risk was low, the reward was high. Here, the risk is high, the reward is low. And just on that, I have been following Alibaba for more than 5 years. Amsterdam Commodities, first time I analyzed it is 2015. Ecker Oil, I have been following for a decade. ADM, look at this Seeking Alpha article from 2019. Berkshire for a decade. Iron Ore for a decade. Chinese companies 5 years. Clarkson is a newer one for a year. I still don't own it. That's what I'm saying on the debt there, and others. And then when it comes to investing, also to finish here with Warren Buffett, usually you can know if something is not for you in 5 minutes. And that's the key value I give you here. This is a value investing channel, and you come here for a value investing perspective on your potential ideas. That's how I hope to give you value. That's why you are subscribed and why you are now smashing that like button. On the 1%, we do also deep dives when there is the potential for that 1%, and then we know everything about the company. So let's start with Target, Constellation Brands. Target, of course, whenever a stock is down so much, there is always the question, Sven, can you analyze it? However, let me do this before I even start analyzing. The stock price shows it boomed on growth, that post-pandemic purchasing boom. However, it's just a retailer. Retailers are usually called by Charlie Munger widow makers. There is no moat, which means it's risky. Costco might have a moat, but that's highly expensive. A buy now is betting on a rebound. With recession, tariffs, unemployment, AI making you lose your job, it's getting riskier. And you see it immediately here in sales. They are trying to put new CEOs to make the rebound. However, the guidance there is to approximately $7 to $9 of real earnings, which means it is a P ratio of 10 to 15. The key question is, will US retail boom again? And then again, just a note here on stocks and the buybacks that many see as great situations there. The company did not repurchase any stock in the second quarter. Look at where the stock is now. Look at where the stock was in 2022. Okay, let me show you the buybacks. No, none now. 8 billion in buybacks. That's crazy. That's 20% of the current market capitalization went into smoke. Further, when it comes to the stock price and rebounding, the projections now are for an even worse retail situation going towards the end of the year. The question is then, from a risk and reward perspective, is that already priced in? Well, the P ratio is 10. The P ratio is likely going to change 12-15. If they can keep the dividend, it's a good dividend. So when it comes to the risk and reward, 5% yield is good. It's not really great. If this is the bottom. If there is a recession, a market decline, this can still go 50% lower because it is retail. So a no for me. You can bet on it, but the upside is maybe 50%, the downside is 50%. Thus, it is not a positive risk and reward situation. And they have been growing their debt levels, which further increases the risks, and these things can spike. Simply bondholders take over the company and you have nothing. So if there is a dividend cut, the stock goes down, the upside is not yet 2x for, let's say, 30% downside. Now you're at 50-50, which is not a positive. Constellation Brands, Berkshire bought there. Let's see what's going on. Also 50% down. Largest beer import company, thus tariffs impact for sure. And they say here, everything is down, earnings are updated, guidance is updated negatively, revenues down, everything down. And you check the drivers there, and the drivers are incremental macroeconomic headwinds, consumer demand, and lower volumes, additional tariffs, and things like that. Now we have Target with retail in the dumpster, we have Constellation Brands complaining about customer, which means I need to make a recession video coming for real tomorrow, and that is the bottom-up way of looking at things. You don't need to look at the headlines, you just look at what the companies are reporting, and this is the first time in a few years that companies are actually changing their guidance, looking at negatives, and then tomorrow we'll discuss whether the Fed or Trump or whoever can save a proper recession around the corner. But in the meantime, if you look at Constellation Brands, there are these ups and downs, but the actual value creation could be around 2 billion per year. Cash flows, that's exactly it, 2 billion per year. Compare it to the market cap, so you are now at an 8-9% with no growth, 7-8% free cash flow yield. Thus the P ratio is around 15. Not great, so I don't know who bought there with Berkshire, but they are known to buy and then quickly sell if things are not great. The thing is that when the stock was twice the current price, the P ratio was close to 20-30, and now the P ratio is just adjusting to normality. A P ratio of 12 is not cheap for such a company, especially with the high competition, with tariffs, with everything. It's not a low risk, high reward situation again. The question is, can you do Novo Nordist, United Health? I've done United Health in the video this Wednesday, so check that out. Let's go to Novo Nordist. Let's go to Novo Nordist, 62% down. The Danish people must be drowning in beer, but that's a different, maybe there is a Danish beer company we can buy. What's going on when it comes to value investing? And when a stock like the current three stocks crashes 50-60%. You have to see whether there is a truly long-term competitive advantage that will create profits long-term that nobody can come in and take. That is real investing. You find those businesses rarely, but that is why I'm looking at so many companies to perhaps find a chance of finding there and then putting it on my research platform for coverage. ADM has been one that has just fallen a few months ago into the buy situation, into a buy level that we discussed here on the channel. Others are on my platform. And what happened to Novo Nordist? 1.2 trillion market capitalization, Danish kroners. They report in Danish kroners, so we're going to discuss that. There was a boom, and after the boom came the bust. If I look at their free cash flows over the first 6 months, 1.2 billion, they'll make around 60 something billion. That is a 5% free cash flow yield. The sales growth is 18%, still good. However, there is so much competition going into the obesity situation, diabetes, that the question is whether profits will keep on growing forever and justify the current market valuation. Because if I look at numbers, diluted earnings per share, okay, 12, so 25, and the P ratio is, as I said, at 50 now, but we have to look at long-term projections to see what is expected. The financial outlook for the year is not the 5% situation that was expected earlier, but now we are at a 3% free cash flow yield on everything lower sales, lower profits, lower margins. And the thing is that in this case, obesity care market share has gone down despite the market still going up. And the question is, when it comes to such high competitive markets, the question is always pricing, your margins, how much money can you make there? And even if the market is booming, you might not make that much money. And this is pharma. Nothing, and then some discovery, something, and then boom, and then the stock busts as all others go into the same business. And that is exactly what happened here. Look at this. Nothing, a little bit. Those that found it here, those are the geniuses. And then boom, and then bust back. But this is very, very difficult to see ahead. I'm not a specialist in pharma. As the first comment said, not my circle of competence, but I can estimate the risk and reward, and that is how I think I give you value. Plus, when it comes to pharma, in 10 years, the profits are gone. So it is a cash flow, not eternally, but it is with a time limit. Then the question is, what of this will do great? What will be the next blockbuster that goes to do really well? So that is, for me, pharma, I'm not going, but it's still pricey from that competitive situation. You must play it, if you want to play it from a portfolio exposure, a few percentage points. Then if it is still oversold, you can buy a little bit more. When it rebounds, you sell, you make some money. But I think from a value investing perspective, it's very, very hard to find something in pharma that are not bets. Nike, we discussed in the video. Let's discuss PUMA. And this was a great thing to discuss, to just show how bad it can get with these fashion situations. We are down 80% on PUMA. It's a brand that likely nobody wants to buy anymore. Sales are down, profits are actually turning negative. And now the question is there any value at a 3 billion market capitalization? Will someone take over the brand and then try to, I don't know, make it private or something to save the managements behind? Everything is down. The company is not profitable anymore. It is unlikely it will recover. Inventory levels are spiking because they cannot sell it at the current prices, so they will have to lower those inventory levels, lower the sales, expect a loss, still try to invest, but then you don't even have money to invest in marketing and everything. But of course, it's the general economic conditions, which is correct. The whole sector of athleisure and sports is going down, and these less brand strength companies are practically going into oblivion. Now there are still sales, still 4 billion in sales, 8 billion per year. So someone might still buy it and take it over and take it private. But if someone wants to take it private, then you look at the value there. Of course, there is the PUMA brand. You look at the inventories. Those inventories have to be sold at minus 50%, which means there is 1 billion to take off the equity, which leaves 1 billion. There is goodwill about $500 million. So I get to 500 million of real tangible values. So someone might offer 1 billion. Someone might offer 3 billion if it goes even lower, perhaps 4 billion private equity, but very, very hard. Therefore, given the goodwill, given everything. Perhaps it's worth 2 billion to someone, perhaps 4, but it's again just a turnaround gamble that value investors, Warren Buffett, doesn't do. Okay, now, back in 2016, speaking of circle of competence, you raised my interest in gold miners like Newmont, and I invested. What's my view now? Gold, silver producers, a lot of requests. Okay, first, Newmont spiked 94% since the beginning of the year, even more since the bottoms here, but look at the chart, up, down, up, down, up, down, up, down. It's crazy how volatile it is. And I was trying to do a YouTube portfolio for educational purposes, and I did a free 2 years ago, buying more all-weather strategy. And the situation there is, okay, if you want portfolio exposure, you can play it with miners. You put it at 7.5%. When the stock doubles, as it did now, you bring it back to 7.5% and you reinvest that 7.5% somewhere else. If it drops, then you buy more and you bring it back to 7.5%. And the key is to take advantage of this crazy volatility that is always there. You get a yield, you get the dividend yield by owning miners, and you get a yield on gold plus exposure. This is a great yield where you get a good return on gold. So the strategy always was, if you want exposure, play with the volatility of gold miners. Gold miners have spiked on gold prices going to 3,600. So this was stagnant, and then we are now in an exuberant situation. However, the company is telling you to sell this stock. Okay, they are returning with buybacks, retiring some debt, and they are focusing on repurchasing. They are focusing on pushing the stock price as high as possible, because if you repurchase 6 billion, in elastic market theory, you increase the market cap by 30 billion, others come in, and that explains what's going on here. So the only way, according to Buffett, to take advantage of this buyback spending is to sell to the company. Speaking which, again, play the gold volatility with miners. Because if we look at profits, if you look at the all-in sustaining costs, total core portfolio, the margins now are, net margins are plus 50%, which means that even if gold prices go even higher, the discrepancy there with such high margins on gold miners will not be big. When margins are, I don't know, 100, costs 150, 1600 is the profit is only 100. When gold doubles, the profit goes from 100 to 1500. Now, when the profit is 1500, if gold goes up, the profits do not increase that much. Then the company is also spending on buybacks to push the stock price higher, to take advantage of this environment for as long as it lasts. They are gold miners, they know these opportunities come here and there, and they need to squeeze every cent by selling the shares. The management is for sure selling the shares. You can see here, they have learned their lessons from the past and they are doing it again. So be careful there. Because if you look now at the yield, the free cash flow for the year, 3.5%, it's not that great. You can say gold prices can go even higher. Then you can say, look at the reserves. If we multiply the reserves by the 1500 margin, this is a 200 billion company. But that's still just a 2x. Here is the margin of 2,000 now. So, great situation. And then you say, Sven, you said yourself that gold will go to 5,000. Yes, I'm still 100% sure that gold will go to 5,000. When? I don't know. Will it first go to 2,000, then to 5,000? Everything is possible, but the question is how good of a protection it is now. And gold will surely go to 5,000 because simply all currencies will be destroyed. The dollar lost 50% of purchasing power in the last 25 years. I believe it will lose 80% of purchasing power in the next 25 years. Protection with gold or gold miners, the question is now, at these levels, how good of a protection it is. Gold is not producing anything, gold miners have a small yield and they are pushing the stock price higher. As long as gold prices are high, these guys are flushed with money and they will do buybacks, which means the stock price will go even higher. So if you want to make 20% fast, buy Newmont. However, as soon as this gold price reverts, if it reverts just a little bit, then sell Newmont. This situation has been the same with, I think, coal a few years ago. So it is about personal preferences and exposure. On the gold exposure strategy, now it should be reduced. Now the yield is a little bit lower, so I don't know what to say. I cannot predict. Now it's just speculation there. If you want higher yields, real value that produces something, check my quadrant video and also check my research platform with my portfolios. 21-day money back guarantee. Everything is in the link in the description below. Now, another stock, ADM is doing well. What about Whirpool? And the stock is destroyed, American producer, and then again, intense promotional environment persists, high competition, retail, and then they discuss overdue recovery because the housing market is in the toilet. Again, speaking of recessions, they are mostly producing in the US, so no tariff significant impact, likely on steel and things that they are importing. However, you see here that interest rates started to bite, home sales, things like that. They have revised their guidance to a P ratio of 15, and the question is, especially if a recession comes, this can get even worse. So again, when we look at the cash flows, the free cash flow, yes, there is this 7-8% yield, but they also have significant debt at relatively high yields. And if this company selling this to Americas is in trouble, I'm looking more of a recession indicator than other. But this is another company at a P ratio between 10 and 15, and the gains simply could be 50% if things rebound, but you can also lose 50% or more if things don't rebound. Again, not a positive risk and reward situation. And then another beer company, Heineken. I said it was not interesting here, then I think it doubled immediately. Now it's back to where it was. But again, P ratio 20, dividend yield is small, and simply maybe it can rebound here, but this was the very low interest rate environment, everything booming, pandemic. Now things are changing. So I would rather see this as the normality, so plus 50%, minus 50% rather than other. So don't get mad if you don't like how I see these companies. I hope I give you value. Don't kill the messenger. See how it fits your portfolio, your risk and reward situations. See how you can accumulate wealth over time from this. Thanks for watching. I'll see you in the next video.